The U.S. market is currently closed for the night. The regular trading session for IBM on October 22nd finished at $287.51, which was actually a strong day, showing a gain of 1.94%. But that is not the story. The real story, the one that defines the entire sentiment as we head into the October 23rd trading day, happened in the after-hours session. Right now, IBM is indicating a massive gap down, having collapsed in extended trading to $268.97. That's a staggering drop of 6.45%, wiping out nearly $20 per share in a matter of hours. This is the perfect, brutal example of expectation versus reality. The expectation leading into this week was that IBM, the old guard of tech, the reliable blue chip, was finally getting its act together. The narrative was that its AI strategy with watsonx and its dominance in hybrid cloud were justifying the stock's steady, impressive climb this year. The reality? Yesterday's Q3 2025 earnings report just landed like a lead balloon. This isn't a minor pullback, this is a sudden, sharp, violent rejection by the market. This isn't the slow, steady movement you expect from a legacy company. This volatility looks more like the price action traders hunt for in names like Tesla stock or Nvidia stock. What we are witnessing is a fundamental, jarring disconnect between the story IBM has been projecting and the numbers it just delivered. For months, the general belief surrounding IBM has been one of cautious and growing optimism. The company successfully spun off its legacy infrastructure business, Kyndryl, a move that was supposed to unchain it, freeing it up to focus on the high-margin, high-growth worlds of artificial intelligence and hybrid cloud computing. The narrative was crystal clear. This isn't your grandfather's IBM anymore. This is a nimble, consulting-heavy, software-driven operation poised to capture a massive slice of enterprise AI spending. Many investors, perhaps using platforms like Fidelity Investments or monitoring their Schwab Intelligent portfolios, held IBM as a safe tech play, a dividend aristocrat with a new, plausible growth story. They saw it as a stable alternative to high-flying, zero-dividend growth stocks, a way to get exposure to AI without the dizzying valuations. But the challenge to that belief, the one just underscored by this 6.5% after-hours haircut, is whether this transformation is happening fast enough or if it's profitable enough. The market does not wait. When a company trades at a forward earnings multiple that implies growth, it must deliver that growth quarter after quarter. This sell-off suggests that the new IBM looks, to Wall Street, distressingly like the old IBM, a massive, sprawling organization that struggles with consistent, high-velocity revenue expansion. This is the core tension that defines this stock. Is IBM a growth company, or is it a value trap? The earnings report seems to suggest the market is leaning heavily toward the latter this morning. Let's really break down this recent activity, because the regular session movement yesterday completely masked the danger that was lurking. The stock closed up nearly 2%. That's institutional buying, algorithms loading up before the print, anticipating a beat and a raise. They were catastrophically wrong. The moment the release hit the wire after 4 p.m. Eastern, the volume in the extended session exploded. We're talking millions of shares changing hands, most likely through sophisticated institutional platforms like the Interactive Brokers platform or the Fidelity Trading platform, which are built for that kind of high-speed, high-volume execution. This wasn't retail investors on the Robinhood app slowly selling off. This was a high-volume, professional, instantaneous repricing of the stock. So, what was in that report that was so toxic? While the headline EPS might have been close to consensus, the devastating number, the one driving this entire sell-off, was almost certainly revenue, and more specifically, forward-looking guidance. The expectation was that the watsonx platform and the Red Hat acquisition would be firing on all cylinders, showing accelerating adoption. The reality is that enterprise spending is tight. CIOs are under pressure. While they want to spend on AI, they are delaying large-scale multi-million-dollar transformations. IBM Consulting, which has been the reliable engine of growth for the past 2 years, likely showed a significant and shocking deceleration. When your entire growth story is based on consulting and software, and consulting suddenly hits a wall, the entire thesis wobbles. This sell-off is also happening against a very difficult macroeconomic backdrop. The Federal Reserve is still holding interest rates high, and that higher-for-longer stance punishes companies that rely on long, complex sales cycles. That is IBM's entire business model. This isn't like Apple stock, which sells a new iPhone every fall in a clean consumer transaction. This is IBM trying to sell a multi-million-dollar, multi-year cloud and AI transformation to a Fortune 500. That's an incredibly tough sell when the cost of capital is 5%. This macroeconomic pressure is the hard reality that IBM's optimistic AI narrative just slammed into. We also need to look at the trading volume over the last few weeks. It's been relatively subdued, suggesting many investors were in wait-and-see mode. That's all changing now. We are going to see a massive, chaotic spike in volume when the market opens. This is when you see the difference between various types of online investing and the investing sites they use. The self-investing crowd, maybe checking their Fidelity mobile app or the Robinhood app, might panic sell at the open. Those using a robo-advisor like Sophie's Intelligent Portfolio or Sophie Invest might see their allocations automatically rebalanced out of the stock. Meanwhile, the active traders using the Interactive Brokers platform are looking for an entry point, trying to scalp the bottom of this drop. This is when online investment decisions get tested. This earnings reaction is also sector-specific. Look at other enterprise software companies. Microsoft is holding up because its Azure and OpenAI integration is seen as a clear, undeniable winner. Oracle is mixed. IBM is now being severely punished because its AI story was, perhaps fairly, perceived as less concrete, more marketing. The market is screaming, "Show us the money." The Q3 report apparently failed to do that. This kind of move also makes investors nervous about their broader holdings in Fidelity mutual funds or Fidelity ETFs that might have a heavy weighting in value tech. The technical picture is, to put it bluntly, broken. IBM stock had been in a solid, beautiful uptrend, setting higher highs and higher lows. It was trading comfortably above its 50-day and 200-day moving averages. This after-hours drop slices through all of that support like a hot knife through butter. It's a waterfall event. When the market opens, the $270 level will be the first psychological test. If it breaks that, we could be looking for support down near 255 or 260, which were support levels from earlier in the summer. This is a significant technical breakdown, and it will take weeks, if not months, to repair this chart damage. It changes the entire complexion of the investment. This is a major inflection point for the stock. I'm curious what everyone else is thinking. Comment below with your honest take. Is this earnings drop a massive overreaction and a buying opportunity? Or is it the start of a much deeper slide for IBM? Let's also consider the dividend. IBM's strong dividend, which was yielding over 4.5% even before this drop and will be significantly higher at the open, is its safety net. This is why many investors hold it in their Fidelity IRAs or other long-term retirement accounts. The expectation is that the dividend provides a floor. The reality is that in a post-earnings panic, the market completely ignores the dividend. The only thing that matters is growth, and the guidance IBM just gave suggests that growth is impaired. The dividend hunters, the value investors, will step in, but they won't step in at $287. They will wait for the dust to settle, perhaps at $265 or $260. This drop is a gift to them, but a disaster for anyone who bought in the last quarter. For those who are new to IBM, let's quickly clarify what the company actually does, because it's not just about mainframes anymore. IBM is primarily a software and consulting company. It operates in several key segments: software, which includes Red Hat and its hybrid platform, plus its AI and data platforms like watsonx; consulting, which helps businesses implement technology and transform operations; and infrastructure, the legacy hardware and mainframe business, which is still highly profitable but not a growth area.